Hello investors, welcome to Simpli Stocks. The market is currently going through a very volatile phase and we are seeing quite sharp movements on a daily basis. But at the same time, this is also a very good opportunity or time to explore quality stocks at lower prices because there are so many businesses that are fundamentally strong, growing well, and they have a good long-term outlook. And even though they are not related to the ongoing war, yet they have still corrected significantly due to the broader market fall. So in today's video, we will be discussing 5 such discounted businesses. But as a SEBI registered research analyst, I need to give you a disclosure or disclaimer that these 5 stocks are either part of my own portfolio or they are part of our tracking or coverage list. So please keep that in mind. Also, this video is not a buy or sell recommendation in any way on these stocks. My aim here is to give you a framework so that you can understand how you can explore and analyze discounted opportunities yourself. With that, let's get started. The first business we will study is Yatharth Hospital. Yatharth currently has a capacity of more than 2,500 beds across 8 hospitals. One of their facilities in Agra was recently acquired. So with its sales adding up, we are likely to see better sales growth in the March quarter results, which will be announced anytime soon. Also, from the December quarter, that is Q3, the pace of sales growth has increased from 20 to 30% to 46%. So basically, whatever work has been done by the management over the last 2 years in terms of opening new hospitals and acquiring others is now clearly playing out in front of us in the form of numbers. The hospital sector is currently going through a capex cycle. Demand is strong and almost all companies are expanding. Among them, Yatharth has been one of the fastest growing companies in the entire sector. And as hospitals and hotels are asset heavy businesses, so it is usually difficult to grow quickly because building a new hospital and then making it profitable takes time. But Yatharth's management has shown very strong execution. They have grown rapidly through a mix of setting up their own new hospitals and also acquiring others. Another interesting point is that this stock is part of the portfolio of not one but actually two ace investors. You will see here that Mukul Agarwal and Vijay Kedia both hold around 1% stake each. This business was already good earlier, and after the correction, the valuation has become even more attractive. You will see hospital companies usually trade at premium valuation because they are asset heavy and defensive businesses. But Yatharth is currently available at around 37 PE. You can see that it has the highest sales growth in the sector, but the lowest valuation. The median valuation in the sector itself is around 43. So if you don't have a hospital stock in your portfolio, you can look into Yatharth once. The company has already grown from 1,000 beds to more than 2,500 beds. And from here, it aims to double its capacity to 5,000 to 6,000 beds in the next 3 years. After Yatharth, another business that has corrected and is now available at a good valuation is Jeena Sikho Lifecare. Jeena Sikho also operates hospitals, but unlike Yatharth, it does not focus on allopathic treatment. Instead, they run Ayurvedic or Ayush hospitals where people go for treatments of Ayurveda, naturopathy, homeopathy, and so on. The management of Jeena Sikho has also executed very well. They now have 58 hospitals across India with a capacity of almost 2,800 beds. Along with this, they also have a portfolio of Ayurvedic medicines and OTC products, which is also doing quite well. And their model is capital light, as many of their facilities are on lease. Plus, compared to regular hospitals, Ayush hospitals require lower investment. So their return ratios are also very healthy. You can see here. And in India, the Ayurvedic treatment market is growing very fast. There was also a positive trigger for it in the budget. The company plans to increase its bed count to 7,000 to 10,000 beds in the next 3 to 5 years, which translates into 35 to 40% capacity growth. If you add another 5 to 10% type growth from ARPOB, meaning that growth which will come from increasing prices or rates, then it becomes a 40 to 50% type growth business available at a PE of 35, 36. So here you can also see their return ratios and the stock is down 30% from its peak. So this is another business that you can study once. Now a humble request. Just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simply Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Coming back to our discussion, the third business you can check out in this correction is Zota Healthcare. Zota operates pharmacies by the name of Dawa India, focusing on affordable generic medicines. The company is expanding very fast. You might have seen Dawa India stores yourself around you or in your city. They now have more than 2,500 pharmacies across India. There is a 60 to even 80-90% price difference between generic and branded medicines. You would recall in our recently discussed video on Shally Engineering that how semaglutide used to cost 10,000 rupees, but after becoming generic, its price has dropped to around 1,300 rupees per month. So think for a moment that in a country like India, where a large part of the population is low income and middle class, this business can do very well in the long term, because say a medicine that costs 2,000 rupees can be bought here for 3 to 400 rupees. So the value proposition is very strong. This stock has corrected significantly and it is down more than 35% from its peak. You won't see PE ratio for Dawa India because the company is currently making losses. Because as I told you, out of 2,500 stores that they have right now, around 1,750 have been opened in the last 2 years only. So when a company expands this fast, obviously costs will increase and profitability gets impacted. But here you need to focus on the direction and growth of the business. Sales growth is currently around 100%, 90 to 100%. And as these 1,750 stores mature, their contribution to the bottom line will also keep increasing. Now see, these are just 5 discounted opportunities. There are many more businesses in the market which are trading at good valuations. Apart from this, there are also many contra bets in the current market, meaning those stocks that have corrected significantly because of the war only, but have such strong business models that they can easily pass through this phase of 2, 3, 4 months of uncertainty. That is why next Sunday, I am conducting a webinar where I'll be discussing such quality businesses that are currently available at attractive valuations due to the correction. The webinar will start around 11 a.m. and the fees to attend it is just 999 rupees. For just 999, you will get to learn about 25 plus high quality businesses that are currently in a high value zone. So if you want to register for this webinar, you can message us on this number, or you can also register through the link in the description below. Moving ahead, the next stock which has seen massive correction in this market fall is EFC India. You will see here it has fallen around 50% from its all-time high, and the market is currently valuing it at a PE of just 40, like as if it is a commodity stock. But there is nothing fundamentally wrong here. EFC operates in the office leasing business. It takes buildings on rent, renovates them, and then leases them out to other companies as office spaces. EFC is part of the flexible workspace segment, which also includes players like, say, Office and SmartWorks. Now, what has happened is that this entire sector has seen an excessive paper supply, meaning earlier only a few players like Office and EFC were listed, but then many other companies came up with their IPOs. So because of this, investors got more options and capital got distributed across multiple companies. There is also some negative news, or say negative sentiment around AI, that this will lead to companies slowing down on expansion and hiring. But see, in such a scenario, large office spaces are more likely to get affected. Flexible spaces are generally preferred by small and mid-sized companies where demand is still strong. Plus, they are called flexible because companies have enough flexibility to, let's say, expand or contract the requirement of their seats. And even if, let us say, there is some slowdown, that downside remains relatively protected here in EFC, as the stock is at such a low PE, only 14, 15 right now. Now, fifth and final business available at an attractive valuation in this market fall is GRSE, or Garden Reach Shipbuilders. I had also made a dedicated video on GRSE recently on how the shipbuilding sector is currently seeing a supply chain shift. New orders are moving from China and Korea towards India because they don't have enough capacity over there. At the same time, the ongoing Iran-Israel-US conflict has further highlighted the need for strong defense systems. Iran is using the Strait of Hormuz as a strategic weapon, and India itself has such a long coastline which requires sufficient warships, vessels, and submarines. After the December quarter ended, GRSE had an order book of almost 8,500 CR. Now, the key trigger here is that company is expected to receive a large 33,000 crore rupees order from the Indian Navy for 5 next generation corvettes. Plus, recently, some progress has been made on the landing platform dock or the LPD ships project, which was stuck for a long time. So overall, in the next 1.5 years, the shipbuilding sector may see orders worth around 2.5 lakh crore rupees for which GRSE can bid. So this is another big trigger for this business, and you can look into GRSE independently. In the end, I have to say that a lot of effort and time goes into this kind of research and making these type of videos. So if you support us by liking this video and yes, also subscribing to our channel, it will motivate me to bring more such content. So make sure to like this video and yes, also subscribe to my channel. I'll see you in the next video. Happy investing.